Greg, welcome. Good to have you with us. Let's sliver this out. I want to focus on car loans, and we're talking here about subprime car loan buyers. That's people with below sort of qualifying credit, high interest rate loans, and so forth. What percentage of the auto loan market do you know is made up of these subprime buyers?
It fluctuates, and the thing is, credit got a little bit loose here the past couple of years, Tyler, and so you saw more and more of these subprime loans being made. Still a very small share of the overall auto loan market, but I think the stress you're seeing is indicative of the fact that a $600 a month car payment's a $600 a month car payment. There's no give there, so when budgets are tight, that's one that we're seeing increasingly becoming a casualty.
Car prices went up. Used car prices went up, hence the loans went up. As we look back and we remember the subprime mortgage market and the cracks in the mortgage securitization market, it did not take high default rates there to cause a systemic crack in the banking business. Is there that possibility here in the auto loan market? And a danger that there are going to be auto lendees, people who have auto loans, who are going to find themselves underwater?
Well, on the latter part, the being underwater, borrowers, that yes, I think that's a likelihood given those inflated prices that we had seen, and the fact that a lot of borrowers, they roll over negative equity or they don't have much in the way of a down payment. And so as the vehicle depreciates, those values may have been inflated, but that doesn't change the rate at which they depreciate. So, yes, I do think we will see.
In other words, if they were to sell that car tomorrow, they would not be able to pay off the balance on their loan.
I think for a lot of borrowers, that's exactly right, particularly if they bought within the last year or two when those values had been pushed up and, were arguably inflated. You heard the stories about, people could sell their used car for more than they paid for it. Well, somebody's buying it, and I think those are most at risk.
So who's going to be left holding the bag on people who can't pay their car loans? Who are the owners of those securitized products? Is it Wall Street?
Yeah, Kelly, first thing is, the auto loan market is much, much, much smaller than what we see in the mortgage market, and the securitization in the auto loan market much, much smaller than what we see in the mortgage market. So I don't want to draw corollaries there. But subprime is the first place where credit loosens and last place where credit loosens and expansion, but it's the first place credit tightens when the economy starts to slow and you start to see, these increasing delinquencies. And I think a lot of those investors that might otherwise be buying those asset-backed securities, they're going to start to command higher yields, and then before you know it, you have tighter credit.
Do you know, generally speaking, who those investors are? Are they, hedge funds, real money? Are they banks? Are they auto companies, other kinds of financial institutions? It's
a little bit of all of the above, but mostly the asset-backed securities, really being bought by a lot of hedge funds, for example, that were pursuing the higher rates of return. You don't see banks delving into that much.
Shepard Smith here. Thanks for watching CNBC on YouTube.